Well, wonderful. They've turned down the music and they've turned on the microphones. So that must mean that we are getting started on international discussions and drivers, which should give you, we hope, an understanding of some of the considerations and circumstances that our colleagues from around the globe face as they engage in discussions about international regulatory issues. So again, we're looking at a high-level discussion of key international issues that are currently shaping the insurance industry and those that are anticipated in the near future. Our session today is going to examine the diverse perspectives and underlying factors that drive differences that are very real as we sit across the table from one another in views and positions within those global discussions. We've got a couple of learning objectives because if you're getting continuing education credit, you have to have some learning objectives. We're going to identify key issues, projects, and activities that are underway or that are planned at the international level. And hopefully you'll walk out of here with an understanding of what drives differing views and positions that are going to underlie those international discussions. And as a production note, our confidence monitor is on the fritz. And so unfortunately, I'm going to have to be reading with my glasses way down here. So I've been in office for 3 years. And when I came in, I was given my predecessor's initial committee assignments. So I walk into my first G committee meeting at a group of insurance commissioners as I'm hearing acronym after acronym after acronym. I was deeply lost the entire time. So before we get started, I wanted to walk you through some of the acronyms that Ryan has had the joy of teaching me over the last 3 years, and hopefully get us a quick level set. So let's start with the IAIS, the International Association of Insurance Supervisors. The IAIS is headquartered in Basel, Switzerland. It was initially kicked off through the leadership of the NAIC, acronyms within acronyms, to provide a forum for international insurance regulators to get together, to talk, and to work through some of the issues that face us. Their work product, ICPs, the Insurance Core Principles, have the characteristics of both of our model laws and our model regulations, but then they also work in, at a high level, some of the material that you would be familiar with in the handbooks. Ryan, the comm frame for the supervision of IAIGs, I'm going to turn over to you so these people can hear a different voice than mine.
Thank you, Director. So CommFrame was developed, it's been maybe about 10 years ago since it started, so it was one of the kind of key lessons learned from the financial crisis of needing to kind of do a better job of addressing group-wide supervision. So it is based on the Insurance Core Principles, but it is kind of adds additional level of things that group-wide supervisors, as well as kind of host supervisors of IIGs would need to think about as they supervise that subset of insurers. That is the acronym there. IAIG is Internationally Active Insurance Groups. There is a set criteria that defines those. So it's the number of jurisdictions in which they're active, and then I think certain thresholds for either premium volume or another.
And a percentage of the premium that they derive from overseas operations. One thing that you may want to be aware of is that there are relatively few IAIGs that are operating both in the United States and around the world. I believe less than a dozen U.S. firms are IAIGs, so it's a fairly rarefied group. Moving to the ICS, the International Capital Standard. The International Capital Standard is, along with the following acronym, aggregation method, is really at the core of a long-standing discussion that has been held by insurance supervisors over the last several years relating to how do we value the worth of very complicated conglomerates that write insurance. And there are differing viewpoints that we'll be getting into as we talk a little bit further today, and different approaches that really get to the heart of what we're trying to convey today. The FSB, the Financial Stability Board, Ryan, you want to talk about that?
Sure. So the FSB is kind of the umbrella group of the individual financial sector standard-setting bodies. So the IAS does insurance. There's other similar bodies on the securities and on the banking side. But kind of above them overlays the Financial Stability Board. It's kind of tasked with looking at the stability of the global financial sector. They have a variety of topics that somewhat overlap with what the IAS looks at, but then they kind of work together to make sure that there's some consistency. One of the challenges is making sure that the insurance perspective is understood and represented in the discussions with the FSB. A lot of times it is somewhat dominated by banking discussions, and sometimes the things we see coming out of the FSB have definitely more of a banking skew to them than necessarily one that is reflective of how insurance operates and how it's regulated.
And I think, Ryan, that feeds nicely into this concept of the global systemically important insurers. You want to?
Sure. So this was one of the takeaways for another financial crisis takeaways was to kind of figure out how to identify and how to mitigate systemic risk that could have an impact across the whole global financial sector. So initially there was this idea that you could identify global systemically important financial institutions, so G-SIFIs, which I didn't include here. But basically the idea was to kind of come up with some sort of methodology where you could use to identify those within the IIS. So the FSB was kind of telling the different sectors to develop these things. Within the IIS, they developed a methodology for insurers. I think even after it was kind of initially finalized, the insurance supervisors weren't too happy with that approach. I think recognizing that there was an overemphasis on looking at single entities rather than the idea that you should also be looking at activities as well. So activities by insurers, but also outside activities that could influence the insurance sector. So the GSI designations were put on hold a number of years ago while the IIS developed a new approach called the Holistic Framework. I think we'll get into that in a bit more details later, but needless to say, I think 2 years ago, the FSB decided to kind of shelve the whole GSI designations in favor of the Holistic Framework, which does take more of both an entities-based and an activities-based approach.
Ryan, you just did a heck of a job with that. So why don't you move on to cover the last three?
Sure.
Just bring it on home.
Sure, we'll do. So the Global Insurance Market Report, this is a publication that the IIS produces every year. It's been around for a number of years, maybe even almost decades. So it's kind of became one of the key takeaways of the holistic framework that the IIS has implemented. It kind of goes through different trends and looks at statistics and analysis of the insurance market over a year. They look at kind of themes that are happening in the sector, what insurance supervisors are doing to address those themes. So it is a good end-of-year report. If you've not seen them, it usually comes out kind of early December. There is also kind of included with that a report on the reinsurance market as well. This kind of changing gears, the Sustainable Insurance Forum. This is kind of a peer organization-ish of the IIS, so they work well together on certain topics. They're based within the UN. A number of NAIC member states are members of the SIF, as well as the NAIC itself. A lot of its work so far is focused on climate risk, but now they're kind of looking at sustainability more broadly and what that could mean for insurance regulation. Another kind of relevant organization to the IIS is the Access to Insurance Initiative. This was started about 15 years ago, I guess, and the idea was to help find ways for jurisdictions, in particular emerging markets and developing economies, to make sure that they have ways to have access and availability of insurance products, that they have financial inclusion efforts. So while a lot of it is focused on those developing and emerging economies, there is a lot of relevance to even jurisdictions like the US who have more developed markets, but also the ones that have populations that are underserved or kind of need more attention for financial inclusion. So I think that covers our background.
So now that we have the lingo down, we're going to move into sort of the broader context. You see on screen a picture of a goldfish in the bowl. Now, there's a variation of this story that's told by a number of folks, and I'll just tell you the story that comes to mind for me. So there are two young fish swimming along, and they happen to meet an older fish swimming in the other direction, who nods at them and says, "Morning, boys, how's the water?" And the two young fish swim on for a little bit, and then eventually one of them looks over at the other and says, "What in the heck is water?" The point here is that we are all products of our environment, that we are all products of the water in which we swim. And until we understand the context in which we all operate and the context in which people on the other side of the table operate, it becomes very difficult to reach a consensus. That's really the purpose of today's conversation. So let's begin by talking about some of the things that drive varying perspectives around the table. Starting with markets. When U.S. insurance regulators sit down with our colleagues from around the globe, we come from very different places. Obviously, the United States insurance market is as developed as any around the globe and arguably the most developed. Compared to people who work in environments in which they're looking at the needs of policyholders who may not have had access to insurance. And what does that mean if you are trying to get an agricultural economy to function in a predictable and sustainable way? The size and the needs of the markets are very different. So the United States represents, I believe, 43% of the premium paid around the globe for insurance premiums. That's really pretty significant. The United States is obviously the world's largest economy, but we're certainly not 43% of the world economy. And then move on to the number and the size of players. The United States has, in its very well-developed insurance market, as all of the people that are sitting in this room know, has a wide variety of the size of the players in the market, all the way from marquee brands like State Farm and Berkshire Hathaway, down to smaller state-focused or regional players whose names you're all familiar with in your day-to-day operations. Now, compare and contrast that with markets in other countries. So, for example, Ryan told me a wonderful story that I'm going to turn over to him about the Norway market.
Sure. I think it's Norway, so I could be wrong. So don't quote me on these jurisdictions. But I think in one of the conversations I had was we were talking about policyholder protection schemes, so guarantee funds and things like that. And so the discussion was going about how you could have such a scheme that works, and you need to have a number of insurers in order to pay in either ex ante or ex post to make sure that those funds work. And one of the jurisdictions was, somebody noted that in one jurisdiction, I think it was Norway, they only had one life insurance company. So how do you have a conversation about the need to have this type of mechanism when it doesn't compute in your jurisdiction because you only have one company that could be able to operate those things? So that clearly creates a challenge. There was, I think, another jurisdiction that had a few players in their life insurance market. I think there was some sort of scandal that basically all of the insurers collapsed, and therefore there was no insurers left. Needless to say, because of the scandal that caused the collapse, the population had no faith or trust for that product anymore, and so basically there was no life insurance within that jurisdiction anymore. So again, things that happen in different jurisdictions can affect kind of how they see their market and what that means in these discussions.
And clearly those stories arise around the globe and yield some differences that are worth understanding. Moving on to the broader society, obviously, if you all recall from your high school economics class, the United States has a relatively laissez-faire approach to business and business regulation. Compare that where, generally speaking, that which is not made illegal is allowed. There's a very different approach to that in cultures around the world, from all but remnant communist systems to heavily social democracy-based systems with elements of pretty significant state control. You have some differences in the effectiveness and efficiency of the financial sector and the investment markets, combined with, in some instances, distribution models that have a lot of interaction with post offices, for example. Moving to public versus private risk-sharing mechanisms. This is, I think, a really important part of the context of the conversations we have when we meet with our international colleagues. Many of them exist in economies where if the health sector isn't completely government-run, that is certainly the fallback position with private sector health risk financing mechanisms on the side. Retirement, we see quite a bit. Obviously, the US market involves a good deal of individual planning for our own retirement needs moving into the future, compared to European economies being the best example of economies where the government takes on a much more significant role.
Go on, story.
I'd love a story,
Sure,
Ryan.
sure.
And I think these people would too. This is an audience. God, you people are just early, I guess. More coffee, something, anything?
So I was at an event in Southeast Asia, and one of the jurisdictions was there. I was having a conversation, kind of asking about what the main challenges that they were facing currently within their insurance sector. And they said, well, our number one thing right now we're dealing with is auto insurance. I said, well, why is that the case? How has this come about? They said, well, it's just been introduced. The government used to pay for everybody's, not only, I think people had to pay for their cars maybe, but the government would cover the insurance. So nobody ever had to worry about any accidents and things like that. So I kind of said, well, doesn't that cause problems with, potential fraud, having the, financial burdens placed on the government and not on the individual? How does that work? And they said, well, that's something that we're playing around with and having to deal with because most people have reacted by not favorably by the idea that they have to pay for this themselves now. So so it was very interesting to kind of have that perspective that, how do you introduce a product to a population that's not been required to have it? And to make sure that people understand the need for it and how it works, and make sure it can operate effectively and successfully.
So moving on in terms of perspective drivers, let's talk a little bit about differences in regulatory structures. We all know, sitting around this room, that states vary significantly in their approaches to regulation, but the differences between one another is nothing compared to where we are internationally. So looking at regulatory structures, while it is not uncommon for insurance regulators to be part of larger organizations that regulate securities and banking, we see a fair amount of that around the world. I find it really interesting that in many instances, Europe in particular, the solvency regulation is separate from market regulation in the same entities. So whereas the banking, securities, and insurance regulators are all together on the prudential side, on the financial solvency side, they say prudential. The market regulation folks are in completely different agencies in many instances. And then as a consequence of that, when we meet with our colleagues at IAIS, the folks that are at the table tend to be the solvency guys that are really approaching problems, even market regulation problems, with that solvency hat. There are some differences in regulatory priorities. Obviously, protecting policyholders is our first role here in a U.S. context, but that is not necessarily the case around the world. Promoting the maintenance of a fair, safe, and stable insurance market may have a higher priority for regulators in other economies. Brian, I can't remember if you have a story on this one or not.
Somewhat, sure. So I think those three main bullets. So protecting policyholders, promoting fair, safe, stable insurance markets, contributing to financial stability. So those come from one of the insurance core principles about the objectives of a jurisdiction's insurance supervision. So I would say everybody around the table agrees that those three are the main key objectives, but kind of how those play out and which ones maybe take priority over another does differ across jurisdictions. So as Director Dunning mentioned, I think we would probably say the first one there is our primary focus, and based off of that, then because of that, you have kind of a safe insurance market in order to protect those policyholders, and then by having a safe market, you have financial stability. I would say there's maybe some other jurisdictions around the globe that maybe see it going the opposite direction, that the focus needs to be on financial stability, and if you have a stable financial system, then therefore you have kind of insurers that can operate in a safe market, and at the end of the day, then that helps protect policyholders. So kind of more of, they get protection on the tail end versus we put it at the front. But I think that does definitely kind of cause some differences when we have conversations about kind of how we go about this and why you do things certain ways. There is the others bullet there too, so I think that also drives some of this as well. There's definitely jurisdictions who have, as part of their objectives, either kind of building up their sector. Clearly, that's maybe more of something in the emerging and developing economies. There's some with mandates for financial education. I would say that that's something that we would consider that we have under the U.S. state insurance regulators have under their hats, but not everybody feels that way. They don't think that they have, that as supervisors, that they have a mandate to do such things, which again, I think we would say, well, ultimately, if you are protecting your policyholders, they have to be educated. So there's a variety of priorities, but kind of how you pick which one that leads the other ones does differ.
And of course, those differing priorities are going to yield differing regulatory approaches. Some of those regulatory approaches reflect underlying cultural preferences, underlying economic preferences, variations between a principles-based versus a rules-based system. Ryan, would you like to talk a little bit? You're okay.
Sure. Yeah. So again, I think that you see this play out different ways with different jurisdictions. I think the application of proportionality is a key one in order to make a lot of international standards work. So how if you have a market like the U.S. where you have a variety of insurers, so you have at the high end IAIGs, you have at the low end like a local county farm mutual. So how do you take an international standard that's drafted to apply to every jurisdiction and all insurers, but apply it in a way that makes sense? So you obviously have to think through, to what extent do certain things maybe you don't really need to do as much, or kind of have a lighter touch when it comes to other insurers compared to ones that are more complex. But again, that's if you don't have a market, if you have a more homogeneous market, how you apply proportionality will change compared if you have one that's more heterogeneous. So I think we see that play out. Again, similar with risk-based, you have a number of jurisdictions that are on the more developed end that have kind of embraced already a risk-based approach to things versus rules-based. I mean, I think we kind of still have a mix here within the US of that. But you do see some of the other jurisdictions trying to update their regimes, especially when it comes to solvency, to become more risk-based. And we might be talking about that later. We'll see. But another thing is that last bullet about the availability of authorities, tools, and data. I think we see this play out quite a bit in our conversations when we talk about what an insurance supervisor needs to do to get in a certain outcome. And some people, based off their authorities, think there's only really one way to do that. We in the US might have other authorities that would allow us to get there in a different way, which we still think would provide the same outcome. So how do you kind of come up with standards that allow for that? How do you have conversations where you can understand that folks have different authorities to do the same, to get to the same outcome? And another big thing is data. I think we've come to realize that we have a lot of data within the US that we collect, and that gives us quite a I don't know if advantage is the right word, but gives us more insights into our industry, how insurers operate, that we can use, which I think the IMF called it enviable world-class data that we have a while back. So, but that also does kind of creates a driver for these conversations.
Which is ironic because I can never seem to get the question I want answered. I never seem to have the data that I want to have at my fingertips. So to find that we are head and shoulders above most of the world, I think is kind of a startling moment. So let's move on and talk about some of the issues that have been front and center for U.S. insurance regulators over the last several years. We have a significant moment in front of us in September, October, November of this year, talking about the finalization of the International Capital Standard versus the aggregation method, and the determination of whether or not those two systems are comparable with one another. There's been quite a bit of work on this, both in the private sector in terms of getting us data, and in terms of work by insurance departments around the country, including by a number of the people in this room, as well, of course, as the NAIC staff. That decision point is coming to a head. And a final decision will be announced before year end. That finding of comparability is really a top priority for the U.S., not only for the state insurance regulators, but also from our friends at the Treasury and the Federal Reserve. The three of us, the three groups, have been broadly aligned on the importance of finding comparability for quite some time. And then from there, we'll move into jurisdictional implementation.
So yeah, I'd say on this project overall, you've seen a lot of those drivers that we just talked through play out. So I think even the initial start of this whole project of the need to come up with a group capital standard was something that we were not particularly sold on. I think kind of the idea of that there's maybe we would see an over-reliance on a simple number of coming up with the capital ratio that is kind of what is the only thing to look at when it comes to looking at the level of capitalization and the solvency position of an insurer is something we probably don't agree with. We have a lot of tools in our toolbox, both quantitative and qualitative, to be able to assess these things, to be able to take action when need be, well in advance of anything getting close to a certain number. So that, I think, was part of the issue with this project from the very get-go. So we weren't necessarily convinced that this was the best way forward, but this was kind of a charge given to the IIS by the FSB kind of at the tail end of the financial crisis. So I think as the work played out, we were trying to come up with an ICS that would work in a US context. I think after a number of years of working on it, it was clear that the direction it was headed would not work for the US. So that's kind of why we decided, well, we are good with the idea of focusing on group supervision and group capital, but I think an aggregation method makes more sense in the context of the US market, whereas the ICS does not.
So, and we've just given you quite a bit of what I would describe as gobbledygook right there. I mean, I really feel like we've added, 6 different acronyms to your vocabulary. So the ICS, we'll just stay with the acronym, has been criticized by parties in the United States as being, making it very difficult to offer to policyholders life insurance and other long-term insurance products. That in and of itself reflects a whole bunch of the things that we've talked about here. It largely seems to be coming down to disputes between European regulators and US-based regulators, and really represents some differing priorities. So, in the US, we have a need for longer-term life insurance products to help people, first of all, manage risk, but also to help finance their retirements moving forward. So having access to those products is incredibly important for our policyholders. On the flip side, maybe less important for insurance regulators in economies like Europe, right, where the government has such a role in their economy. The other part of that that I don't believe we touched on was that the United States has a very well-developed system of guarantee associations. The guarantee funds, which you're all familiar with, really allow us a certain degree of latitude to allow for innovation in the market, to allow for a little bit more risk to be taken by our insurers, knowing that, God forbid, something should happen, but policyholders will, to some very large degree, be taken care of. But in a context of Europe, where those well-developed guarantee associations largely don't exist, the consequences of failure mean wiping out the policyholders in their society. So the pressures on the various regulators really vary depending on which side of the table that you're sitting on. And we're seeing some of that coming to head September, October, November, as we move to this final decision as to whether or not the United States is going to continue to have its approach recognized as comparable to what the Europeans are doing. I'm sorry, Ryan? No, I'm going to turn it over to you because I've already, lectured these nice people long enough.
No problem. So the next key issue we wanted to focus on is financial stability and systemic risk. So I kind of touched on this a bit when we were on the acronym slide. So this continues to be an evolving approach. So as I mentioned, there was initially this idea of you could just simply have a methodology for identifying global systemically important insurers, but then the IAS has moved to this holistic framework. So that kind of was approved back in 2019. In the meantime, jurisdictions have gone about implementing the holistic framework. The way it's designed, a lot of it picks up existing insurance core principles. It picks up elements of ComFrame. So there wasn't really anything kind of brand new from that perspective, but rather it was kind of identifying those things that would be specific when you wanted to focus on financial stability, macroprudential supervision, things like that lead to financial stability and systemic risk efforts. So the IS has done a lot in kind of moving to this new approach. I'd mentioned the Global Insurance Market Report, but there's also an annual collective discussion, which involves the data collection, both from individual insurance companies as well as the supervisors. So we're part of that effort every year. So at the end of the day, there is kind of this idea that you can kind of track those trends, those potential risks, understand what jurisdictions are doing to address those, whether those require more collective effort. So it has definitely been a change in approach, and I think one that both the IAS members like, but also one that I think the FSB itself has recognized as a better fit for the insurance sector. So there's been a lot of effort on implementation assessment. The U.S. was assessed, I think, back 2020 to 21. And now they're doing, as part of, I think, a group of 10 jurisdictions that were assessed to see how well we had implemented those things. And they've also been flagging areas for future work, which I think maybe we get into on the next slide.
Wonderful.
Which we can move to now. I think. Let's see. Oops.
So, an emerging project at the IAIS relates to resolution and recovery planning. These are incredibly important tools for European regulators, less so in our market. The idea being that insurers should have on the shelf a plan and to think about how they respond to challenges to their solvency position. These documents can be very long and very involved and represent a fairly significant regulatory and compliance lift. That project and that work is moving forward at the IAIS, and it is of some concern as many of the tools that we've seen developed and spun up at the IAIS become projects that get undertaken here at the NAIC later. And so certainly worthy of attention. There are some challenges to resolution and recovery planning. I think one of the best is that, quite frankly, if you can see the train coming down the track, one would think that one would get out of the way. I still am skeptical that people are going to fail in the way that they plan to fail. And hopefully, if they see failure coming, they will plan their way out of it. But here we go. So resolution and recovery will be probably the issue on the horizon that will be driving much of the discussion in the coming years at IAIS. Ryan, you want to talk about monitoring global risks and trends?
Sure, I'd be happy to. So this, again, maybe ties to what I just mentioned on the last slide. So kind of as part of the IAIS's holistic framework, they are doing a lot of work collecting data, as I mentioned, from both insurers and jurisdiction supervisors from various jurisdictions. This requires a lot of work, so thanks to, if there's any insurers in the room who've helped with that, thank you very much. I know it's a lot of work from our end as well. But I think it is very helpful to kind of figure out, to get maybe a level set of data to help better understand the trends, what's happening around the globe, what might be happening in one region that could affect another. But it does come with its challenges. I think, as part of these different drivers, people define some of these things different ways. I think one of the challenges is that they have been trying to introduce, I believe this year, maybe two, I guess this is the second year, some data on climate, and that gets defined and quantified different ways across jurisdictions. So figuring out a way to kind of come up with maybe more of instead of coming up with one set definition, it's maybe more about coming up with a principle of what people have in mind when they think about these things. And that way you can kind of drive these data collections, maybe not solve it in 1 year, but year after year, you can maybe get a bit more quality data and avoid some of the kind of lack of cohesiveness that maybe shows up sometimes. So that's been one of the challenges in this, although it has been a lot of work and has improved, I think, tremendously over the last couple of years. And again, this helps feed into the work that's done on addressing, identifying and kind of figuring out ways to address risks, figuring out themes. I believe this year's report's themes are on both the use of asset-intensive reinsurance and cross-border reinsurance, but then also, again, looking at some of the impacts, so macroeconomic impacts on the insurance sector. So looking at kind of the impact of credit risk, market risk, a few other risks that are relevant. So we'll see that. There will also be next year a special topic theme on, for one of the global insurance market reports on natural catastrophe risks and what jurisdictions are doing to identify and address those, but also any potential financial stability risks that might come with that. So more to come on that area in the future as well.
So as we move into our last slide, I'm going to give you guys fair warning. We have about 10 more minutes. And so you have a few minutes to come up with questions so that we make sure that we get you all of your precious continuing education credits. So fair warning, because if we don't get the questions asked, we don't get all the credits to which you are entitled. So we have 2 more issues to cover. I'm sorry? We have 5 more issues to cover. So maybe, I don't have to call people out by name, although I'm not above it. So moving to climate and resiliency, Ryan, what do you got?
Sure. So yeah, as I kind of just mentioned, one of the main topics that's been a focus of the IAS as well as other bodies over the recent years. So the IAS kind of took an approach to come up with a steering group in order to figure out what the best approach to look at this topic, given that it does cut across so many different areas. So the idea was to kind of identify gaps that might exist within its current materials, but again, kind of looking at different, like what climate means in the context of governance and risk management, for market conduct, maybe more on the financial side when it comes to valuation investments, and then on the supervisory side with review and reporting, disclosures, and supervision activities. So there's been 4 public consultations on a variety of topics under the climate umbrella over the last year and a half or so. So the IAS is kind of getting its final package out for consultation right now. We've got a G committee call scheduled for later in October to discuss those. But you will see that paper. So the idea is that all these different topics will kind of come together in one cohesive paper. And that should come out from the IAS at the beginning of next year. But then also kind of pivoting what should the IAS be looking at beyond that. And I think that's part of what will be discussed actually later this week, as they've identified climate as one of the strategic themes for the next 5 years. As the IAS does that work, there's also obviously a need to work with partners that are addressing these things. So SIF and FSB that I mentioned earlier have this as a focus. So the importance of kind of leveraging the work of others rather than trying to repeat it or start the wheel from scratch. But again, this is probably a topic that we'll continue to be hearing about and working on over the coming years.
Moving over to protection gaps, one of the areas that I think every insurance regulator, both in this room and around the table and every room we're in, is concerned about, relates to protection gaps. Do people have access and the ability to afford the insurance protection that they need to take care of themselves, their families, and their businesses? Identifying gaps and potential ways to address them is work that is ongoing at IAIS, as it is in this room and others. And we anticipate that will continue. IAIS has been starting with gaps that are particularly tied to natural catastrophes, but we're looking at others. So with that, Ryan, we got 3 more issues, and then we're going to start getting some questions from this nice group of people. Moving over to cyber and operational resilience. Again, cyber insurance is of huge concern internationally, as it is in this room. Having people look at the risks and, I think more importantly, the capacity of the private market to meet those challenges. It's of deep concern in all of those rooms. in terms of, we're spending a fair amount of time looking at the tools that we have at hand on insurer resilience. Moving over to technology and digital innovation, again, the U.S. has really staked out a leadership position in terms of technological innovation, but that's yielding, I think, a little bit of a head start for us in terms of identifying supervisory best practices. And again, seeing a number of my colleagues around this room who've spent a whole bunch of time looking at artificial intelligence and machine learning. Those conversations are a little behind us, going around the globe, but they are certainly ongoing. And then moving, last but not least, to financial inclusion, relating to DE&I more broadly, looking at supervisory practices and capacity building. In particular, that would seem to yield a new role for organizations like A2II to come to the table and help build better markets for the people that they serve. Ryan, is there anything you want to add to that?
Yeah, I would just maybe note with those kind of 5 topics that we just covered at the end here, I think as we've been talking about drivers and kind of how people see these things differently, I think with these 5 topics, these are more emerging issues, challenges, risks. I think these affect every jurisdiction around the globe. They might play out differently, but I think that you see kind of the recognition of the need to kind of collectively talk about these things, how they're playing out, and what are potential tools, approaches to address these things, because I think compared to some of these more, traditional areas like, capital and things like that, when it comes to addressing these new risks, I think these are things that face all jurisdictions, all supervisors at the same time. They're all evolving somewhat quickly, so it's better to work together and on these things. So I think you'll see maybe what the solutions are a reflection of those drivers, but I think the ability to talk about them is less, causes less issues because of those differences that may exist.
Thank you, Ryan. It's a nice way to close. With that, we have 3.5 minutes that need to be filled with questions so that you and our at-home audience can get the continuing education credits that you deserve. And I'm seeing some smiles around this room. Oh my gosh.
Hold on, we've got a mic coming your way, so that might help.
Thanks, Miguel.
Because we've got our online audience as well.
Thank you. So, here in the United States, we have insurance commissioners that are elected officials. We have others that are, appointed by their governors or appointed by other governing bodies. Some are nested below governor's cabinet. So can you just comment generally, internationally, how are insurance supervisors put into that position, and maybe how it's different or the same here as the U.S.?
Well, the last time our system was evaluated by non-U.S. entities, one of the things that they pointed out was that my colleagues are either directly elected or appointed generally by governors. Sometimes they serve a term. And it was pointed out, the observation appeared to have been that that was a weak point of the U.S. system, because our colleagues in Europe and other locations work for enterprises where they're a couple layers down from political accountability. And that is a point that is of deep confusion for some of our colleagues around the table. However, much of what we do is subject to the deep confusion of our colleagues around the table. And so this is yet another feature, and gosh, I wish I would have remembered that, because I found it pretty funny myself. Of course, they also find it very funny that Nebraska has its own insurance regulator. Now I look back across the table at Slovenia and think, really? Come on.
You mean that in the nicest way, though?
No, I don't.
Okay. I'm not sure if there's we have much detail on the variety of ways the different jurisdictions are, their kind of head of authority is picked, but I think, yeah, it is more typically bureaucratic, kind of slotted in a bureaucratic approach.
So when I meet with colleagues from, say, the Irish insurance regulators, they work as part of the Central Bank of Ireland. The Prudential Regulatory Authority reports up and through the Bank of England. So very different from our systems.
Hopefully a quick question. As you were talking through the solvency of U.S. versus non-U.S., here we have guarantee funds that fall, another layer of protection. Is there anything like that comparable at the international world?
No, I mean, not as much. And sitting here, I was sitting here thinking, oh my gosh, we buried the lead. And that absence of guarantee associations, I feel, is a significant driver of some of the differences that you would see in terms of regulatory approaches. Again, these are regulators who are walking tightropes with no net beneath them. And so, God forbid, an insurance company goes under, there are widows and orphans who are not getting paid. They don't have the ability to look to the Guarantee Association to pay for a house that's just burned down, et cetera, et cetera, et cetera. And it's I think, a significant challenge for those regulators.
Okay, yeah, so my question is this, because I'm actually really happy you brought up the issue of, climate and resiliency, and because I know in recent years, we've had a lot of like extreme temperatures and, unexpected weather phenomena happen, and a lot of people have suffered and even died because of such things. And so I guess the question I have is, do you or anyone else, as far as regulators or what have you, have the ability and the willingness to, to basically enact, if not regulations, then at least lawsuits to actually hold private entities and even governments accountable for failing to take the actions necessary to combat climate change? Because I know that not only do you have some bad effects of climate change, but then it also seems like governments regularly fail to meet climate change benchmarks set by international bodies and all of that. So I was just wondering if you could speak to that.
Well, I would tell you that as we wrap up, and this nice group of people has to leave to the next session that they need to attend, climate discussions are always a hot topic here at the NEIC. We spend a fair amount of time looking at those issues as we do internationally. So with that, you and I can take this conversation offline so that we can let this nice group of people go to lunch. Thank you all very much. Take care.